Nearly $1 trillion disappeared, 929 billion to be exact. That's bigger than Saudi Arabia's entire GDP, larger than every cryptocurrency market at its peak. And it evaporated from the plumbing of global finance while everyone watched something else. You won't see this on the evening news. You won't see Congress demanding answers, because the system that fractured is the system nobody explains and nobody pays attention to until catastrophe arrives. If that sounds familiar, good. Every modern financial crisis follows the same choreography: hidden stress, ignored warnings, boring plumbing, sudden cascade. We are watching that script play out now. Let me show you where that $929 billion actually went. Commercial real estate debt, specifically the shadow banking system that finances office buildings, shopping centers, and apartment complexes across America. Not the traditional bank loans you hear about, the securitized stuff, the part that operates in the gap between regulated banks and public markets, the plumbing nobody monitors until it breaks. Here's the scale most people miss. The commercial real estate debt market in the United States is roughly $5.6 trillion. That's bigger than the entire junk bond market, bigger than the leveraged loan market. And a massive chunk of it sits outside traditional banking, hidden in structures most investors couldn't identify if you showed them a term sheet: investment trusts, collateralized loan obligations, private credit funds, offshore vehicles, layer after layer of leverage built on the assumption that office buildings will always generate rent and property values will always recover. That assumption just cracked. $929 billion in losses represents the repricing of commercial real estate assets as interest rates stayed elevated, office occupancy collapsed post-pandemic, and refinancing windows closed. Buildings purchased at 3% cap rates when money was free now face 7% refinancing costs in a world where hybrid work cut demand by 30%. The math doesn't work anymore. And when the math stops working in leveraged systems, the structure doesn't adjust gracefully. It fractures. Why does this matter more than a stock market correction or a crypto blowup? Because commercial real estate debt is stitched into the balance sheets of pension funds, insurance companies, regional banks, and foreign investors who thought they were buying safe, boring yield. It's collateral for other loans. It's the asset backing securities held by money market funds your neighbor thinks are as safe as cash. When this system loses $1 trillion in value, it doesn't just hurt landlords, it stresses the entire financial web. And here's the part that should keep you awake. Leverage amplifies everything. A building purchased with 70% debt doesn't need to lose 100% of its value to wipe out the equity. It only needs to lose 30%. And when equity gets wiped out, the debt holder takes losses. And when debt holders take losses in securitized structures, those losses ripple through tranches, triggering margin calls, forced sales, and liquidity spirals. That's not theory, that's mechanical progression. The leverage ratios in commercial real estate right now are staggering. Many deals originated in 2020 through 2022 were structured at loan-to-value ratios of 65% to 75%. Some stretched to 80%. That means a 20% to 35% decline in property values pushes equity to zero and forces lenders to either restructure, extend, or foreclose. And here's the trap: everyone can't restructure at the same time. Someone has to recognize the loss. Someone has to take the write down. And the longer everyone pretends the assets are still worth par, the bigger the eventual snap. This is textbook fragility. Complexity hides risk. Leverage amplifies it. Opacity prevents early response, and interconnectedness ensures that when one node fails, the stress transmits. We've seen this movie before. Different instruments, different jargon, same choreography. 2008 was subprime mortgages packaged into securities nobody understood. 1998 was derivatives exposure at a hedge fund nobody thought mattered. 2023 is commercial real estate debt in shadow structures everyone assumed were boring and safe. The pattern is always the same. Stage 1, a market everyone relies on, develops hidden stress. Stage 2, the stress gets ignored because it looks too technical, too boring, or too contained to matter. Stage 3, the system passes an invisible threshold where losses can no longer be quietly absorbed. Stage 4, the fracture becomes a cascade, and suddenly everyone realizes the thing they thought was plumbing was actually a load-bearing wall. Right now we are past Stage 2. The $929 billion loss is the market's way of telling you the hidden stress just became visible stress. And visible stress in leveraged, opaque, interconnected systems does not resolve itself quietly. It either gets bailed out, restructured under emergency conditions, or it cascades. There is no fourth option where everything just goes back to normal because everyone wishes it would. So when you hear $929 billion and wonder why it's not dominating every headline, understand this: the complexity is the camouflage, the boring surface is the trap, and the silence is not evidence of safety. It's evidence that most people still don't understand what they're looking at. By the time the crowd figures it out, the repricing will already be finished, and the survivors will be the ones who saw the pattern and acted before the cascade. This is not the first time boring plumbing broke the world. Let me show you the pattern so you can see we are not dealing with something new. We are dealing with something that repeats because the incentives, the structures, and the human psychology never change. 1. Subprime mortgages. Everyone remembers Lehman Brothers collapsing. What most people forget is the 2 years before that, when the fracture was already visible to anyone paying attention. Housing prices peaked in 2006. Defaults started rising in early 2007. Bear Stearns funds blew up in June 2007. And all through that period, officials kept saying the same thing: the subprime problem is contained. It wasn't a lie, it was structural blindness. They genuinely believed complexity could compartmentalize risk. Here's what actually happened. Mortgages got sliced into securities. Securities got sliced into tranches. Tranches got repackaged into collateralized debt obligations. CDOs got leveraged by hedge funds and held by pension systems that thought 888 ratings meant safety. Nobody understood the full chain. Everyone assumed someone else had done the homework, and the entire structure rested on the assumption that housing prices don't fall nationally. When that assumption broke, the complexity that was supposed to spread risk instead amplified losses. A 20% decline in housing didn't produce a 20% loss in the system. It produced total wipeouts in entire tranches, liquidity freezes, and a global financial crisis. The lesson: when leverage meets opacity in an interconnected system, small cracks become catastrophic failures, not because of villains, because of math. 1. Long-term capital management. A single hedge fund you'd never heard of nearly took down the global financial system. LTCM ran sophisticated arbitrage strategies using massive leverage. At its peak, the fund had equity of $4.8 billion and notional derivative exposure over $1 trillion. They were making tiny bets amplified by enormous borrowing, and it worked beautifully until Russia defaulted on its debt in August 1998 and liquidity vanished from markets LTCM assumed were always liquid. Within weeks, the fund was insolvent, and here's why it mattered. LTCM's counterparties were every major bank on Wall Street. If LTCM failed, forced liquidations would have triggered margin calls across the system, collapsing prices in markets where LTCM held positions and destroying banks that were on the other side of those trades. The Federal Reserve didn't bail out LTCM directly. They organized a private consortium of banks to inject capital and unwind positions in an orderly fashion, because the alternative was systemic collapse. The lesson: size doesn't have to be large if interconnectedness is high. A $4 billion fund mattered because the derivative web made failure contagious. The pattern across both cases is identical. Complexity hides risk. Leverage amplifies losses. Opacity prevents early intervention. And when the stress becomes visible, it's already too late for individual actors to de-risk without triggering the cascade. So everyone freezes, everyone extends, everyone pretends, until the pretending stops working and the system reprices in days what it refused to acknowledge for years. Now look at today. Commercial real estate debt, $929 billion in losses. The same choreography. Complexity: loans packaged into commercial mortgage-backed securities, sliced into tranches, held by funds operating with borrowed money. Leverage: loan-to-value ratios of 70% to 80% on properties now worth 20% to 30% less. Opacity: shadow banking structures, private credit funds, offshore vehicles that don't report to regulators the way banks do. Interconnectedness: insurance companies holding CMBS tranches, pension funds chasing yield in private real estate debt, regional banks with concentrated exposure to office buildings in second-tier cities. The $929 billion is not one dramatic failure. It's the aggregate repricing across thousands of properties, hundreds of securitizations, and dozens of lightly regulated structures that all made the same bet. Office buildings will always generate rent, and property values will recover. That bet is failing in slow motion. And slow motion failures in leveraged systems are more dangerous than fast crashes because they give everyone time to lie to themselves about whether the problem is real. So where exactly is the stress concentrating right now? Regional banks with commercial real estate loan books exceeding 300% of their capital. That's not theoretical, that's disclosed data. Banks like New York Community Bancorp already took massive write-downs in early 2024. Others are quietly extending loan maturities, hoping occupancy rates recover before the next refinancing window. Hope is not a strategy, it's a delay mechanism. Insurance companies and pension funds holding private real estate debt are marking assets at outdated valuations because the structures allow quarterly or annual revaluation, not daily market pricing. That means the $929 billion loss is partially hidden in financial statements that haven't caught up to reality yet. When those marks reset, capital ratios fall, and regulators start asking uncomfortable questions about solvency. And then there's the contagion map. Property owners default, lenders take losses, securitizations get downgraded, funds holding those securities face redemptions. Redemptions force asset sales push prices lower, lower prices trigger more defaults. This is not a scenario. This is how leveraged real estate markets break. We watched it happen in 2008 with residential. We are watching it again with commercial, different buildings, same mechanics. The stress indicators are already flashing. You just have to know where to look. Commercial mortgage-backed securities spreads have widened by 150 to 200 basis points over the past 18 months. That's not noise, that's the market repricing risk in real time. Credit default swap spreads on real estate investment trusts are trading at levels last seen in 2020, and quietly, without press releases, several private real estate funds have imposed redemption gates limiting how much capital investors can withdraw. When funds gate redemptions, it means one thing: they don't have the liquidity to meet exits without triggering fire sales. Emergency liquidity facilities are being activated but not publicized. The Federal Reserve's Bank Term Funding Program, created during the 2023 regional banking crisis, is still being used by institutions that need short-term collateralized lending to avoid selling assets at distressed prices. The Fed doesn't announce which banks are tapping these facilities. They just show up in the aggregate data, and the aggregate data shows usage is not declining. It's stabilizing at elevated levels. That tells you the stress is persistent, not transient. So why is no one talking about this? 3 reasons. First, complexity is camouflage. Commercial real estate debt is boring. CMBS tranches don't generate viral tweets. Shadow banking structures don't make good television. So media focuses on things people already understand. Stock market moves, inflation headlines, political theater. Second, political incentives. This is an election year. Nobody in power wants to be the person who sparks a panic by saying the plumbing is cracking. So everyone downplays, everyone extends, everyone quietly coordinates to prevent the narrative from spiraling. Third, the distraction is working. The public is focused on interest rate speculation, tech stock valuations, and geopolitical headlines. Meanwhile, the fracture in commercial real estate debt is spreading beneath the surface, unnoticed by anyone not reading credit market data. Here's the stage assessment. We are not at early warning anymore. We are at active fracture. The $929 billion loss is not a projection. It's already materialized in asset markdowns, loan loss reserves, and fund redemptions. What happens next is not whether the fracture grows, it's whether the system can contain it or whether contagion accelerates. Let me show you how this cascades if containment fails. Week 1, spreads widen further. Headlines call it healthy price discovery. Analysts say commercial real estate is stabilizing at new valuations. Nobody panics yet. Week 2, a mid-sized regional bank discloses significant commercial real estate loan exposure and misses earnings. Stock price collapses 40% in 2 sessions. Depositors start moving money to larger institutions. Week 3, the bank announces it's exploring strategic options. Translation, they're looking for a buyer or a bailout. Other regional banks with similar exposure see deposit outflows accelerate. Week 4, a prominent real estate fund suspends redemptions entirely. Investors realize they're locked in. Panic spreads to other funds. Week 5, margin calls force leveraged holders of CMBS to liquidate. Prices fall further. Downgrades cascade through tranches. Week 6, regulators step in with emergency measures, liquidity injections, and coordinated messaging to prevent systemic collapse. This is not prediction. This is mechanical progression. When plumbing fails in leveraged systems, the cascade follows a script. Now here's what most people believe that will destroy them when this happens. Comfortable lie number 1, the Fed will just print money and fix it. Reality, the Fed has constraints. Inflation is still elevated. Currency devaluation matters. Political pressure exists. And even if the Fed intervenes, intervention creates second-order effects. Injecting liquidity stabilizes markets but weakens the dollar and reignites inflation concerns. Choosing stability over currency strength is a real trade-off, not a magic solution. Comfortable lie. Number 2, my bank is safe because it's regulated. Reality, interconnectedness means isolation is impossible. Silicon Valley Bank looked safe until depositors realized their assets were underwater and liquidity vanished in 48 hours. Regulation provides guardrails. It does not eliminate contagion risk when the entire sector is stressed. Comfortable lie number 3. This is contained to commercial real estate. Reality. Contagion math does not respect sector boundaries. Banks holding commercial real estate loans also hold residential mortgages, corporate credit, and municipal bonds. Pension funds with real estate exposure also hold equities and treasuries. When one asset class forces losses, institutions de-risk across portfolios. That spreads stress everywhere. So what do? First, hold liquidity. Cash is optionality. When markets dislocate, the people with dry powder buy assets at distressed prices. The people forced to sell get destroyed. Second, reduce leverage in your own portfolio. If you're borrowing to invest, you're replicating the fragility that's breaking the system. Third, audit your exposure. Which bank holds your deposits? What assets back your money market fund? Does your pension have commercial real estate debt? Know what you own. Fourth, watch the signals. Monitor CMBS spreads. Watch for weekend policy announcements. Track insider selling at regional banks and REITs. Those are crisis signatures. Who wins when plumbing fails? Flight to safety assets, treasuries, gold, defensive equities with pricing power and low debt, distressed debt specialists who buy defaulted loans at 20 cents on the dollar, companies that can survive without constant refinancing. Resilience gets rewarded when fragility gets punished. The goal is not to time the exact moment the plumbing breaks completely. The goal is to avoid being forced to sell at the worst possible moment. Resilience beats prediction every time. And if you're positioned right, a crisis is not the end. It's a repricing. The people who survive get to buy the future from the people who didn't.